How does monetary policy manage inflation expectations? Have you ever wondered how central banks keep inflation in check? The answer lies in managing inflation expectations. This process is vital for economic stability and growth. Let's break it down. Inflation expectations are what people think will happen to prices in the future. These beliefs shape how households, businesses, and financial markets act today. If everyone expects prices to rise, they might demand higher wages or increase prices, creating a cycle of inflation. On the other hand, if expectations are stable, it helps keep actual inflation in check. Central banks like the Federal Reserve in the United States play a key role in this. They set a clear inflation target, often around 2%. This target serves as a guide for the public. When central banks consistently aim for this target, it builds trust and reduces uncertainty. This trust helps people plan their spending and saving more effectively. One of the main tools central banks use is policy interest rates. By raising or lowering these rates, they can influence borrowing costs and overall demand. For instance, if a central bank raises rates, it usually cools down spending and can help lower inflation. This action signals to everyone that the bank is serious about controlling inflation. Another important method is forward guidance. This is when central banks communicate their future plans regarding interest rates and inflation. By sharing this information, they can shape public expectations even before any changes happen. Clear communication is key to keeping expectations anchored. Central banks also respond to inflation expectations in their decision-making. They don't just look at current inflation rates but also consider what people expect in the future. This helps stabilize long-term expectations and overall economic activity. Credibility is essential in this process. If people believe that the central bank will act to maintain price stability, their expectations will remain anchored. This means that even if actual inflation fluctuates, people will trust that it will return to the target level. Monitoring inflation expectations is another critical aspect. Central banks look at surveys and market indicators to see if expectations are aligned with their target. If they notice a drift away from the target, they may adjust their policies accordingly. In practice, when inflation expectations are well anchored, it reduces volatility in both inflation and economic output. This stability means that unexpected events have less impact on actual inflation. It also lowers the risk of hitting a point where interest rates cannot go any lower, limiting monetary policy options. In summary, managing inflation expectations involves setting a clear target, communicating effectively, responding to both current and expected inflation, and maintaining credibility. This management is essential for achieving price stability and supporting a healthy economy.